as well to CIGI, the Balsillie School, and Waterloo. It really is a treat for us to host this session here through the weekend. What I propose is we're going to go in the order in the program. I'm not going to introduce the panelists. You have their bios, but we'll go in the order that they appear in the program, other than I will go last. So without any further introduction, I'm going to turn to Pavlina, who will lead off, and then turn to Mario, and third Barry, and then I'll wrap up. Time permitting, we may have a bit of a discussion amongst ourselves, but certainly want to leave time for questions, comments from the audience. So Pavlina, over to you, please.
Thank you to be here. I have a 20-minute presentation, but I will make that available to you in the PowerPoint. So I will try to condense just a couple of key arguments here in the 10 minutes that we've been asked to use. And this is my motivation for my talk. My point of departure is this famous quote that you have heard many times from Keynes about the two outstanding faults of economic society, namely being the failure to produce full employment and the arbitrary and inequitable distribution of wealth and incomes. I think that the exact same verdict can be leveled at economic policy as well. And I'll go a step further to argue that, in fact, our failure to solve the first problem aggravates the second. Even more modern macroeconomic stabilization efforts tend to aggravate, not only aggravate income inequality, but tend to contribute to income inequality, to be themselves inequitable. So by now you're all familiar with the data, so I'm not going to go through all of the charts that I have, but you know that there is a general break in the series in income inequality sometime in the 70s, 75, where income inequality sort of erodes very drastically in the last 30 to 40 years. Now, if you look at business cycles, if you look at average income growth and its distribution in every business cycle in the post-war period, you actually notice that income inequality starts eroding from the beginning, from the entire period, of course more precipitously and in the last 30 or 40 years. And this is, this looks at the distribution of income from peak to trough. Look at average income growth from trough to peak in every business cycle. And you see that, with the exception of the first recession in the early 50s, the top 10% tend to get increasingly greater share of the income, where in the last recessions, they take all of the average income growth. And in fact, this latest period represents the largest transfer of wealth to the top in history. And we have learned how to stabilize incomes. We have discovered the role of government. We have discovered counter-cyclical macroeconomic stabilization. So relatively quickly, we have learned how to grow incomes. What we have not learned is how to make sure that these are that the distribution is shared relatively more equitably. And so I connect these trends to some pervasive, deep-seated problems in the labor market that have been brewing throughout the entire post-war period. And again, I'm not going to go through all of these charts, but just to point your attention to the general uptrend in long-term unemployment as a share of total unemployment. It's been on a secular uptrend for the entire post-war period, and now it comprises more than 50% of the unemployed is stuck in long-term unemployment, as well as this slower recovery in payrolls, which seems to that data seems to have an exponential growth. So it takes longer and longer to recover the lost payrolls from previous peak. Right? And we also have a whole number of problems in the labor market I can't discuss right now. But why fault macroeconomic policy? And my argument is very basic, that we tend to execute macroeconomic stabilization in a trickle-down fashion. And I don't just mean the conventional meaning of trickle-down policy that we associate with supply-side policies. My argument is that for any policy to the extent that we fail to stabilize employment, we fail to produce full employment over the long run, but we particularly fail to stabilize employment at the bottom of the income distribution, then that policy would be inequitable. To the extent that cutting top marginal tax rates explicitly favors incomes of the wealthy, but it doesn't quite trickle down in the form of jobs and stable incomes at the bottom of the income distribution, then that policy by itself, by definition, is inequitable. But you could make the same kind of argument even for demand-side policies. And so I want to distinguish between two types of demand-side policies. So the more modern, preferred version of aggregate demand management is one that finds its pedigree in the new economic consensus, and that's what is now called the policy through the fiscal components of monetary policy. So again, we tend to favor monetary policy, but now we have these things called so-called fiscal components that essentially represent direct subsidies to banks and the direct purchase of toxic financial assets as a means of macroeconomic stabilization. There's a whole theoretical motivation behind these kinds of policy tools that we're employing. But the trickle-down mechanism is, again, from the financial sector to the real sector, from bank balance sheets to household balance sheets, from improvement in cash flows and profits in the financial sector that is supposed to then translate into increased lending and investment through this wealth effect. And then that would produce growth and then the requisite number of jobs. Again, notice that employment is once again at the far end of the transmission mechanism in this sort of demand-side mechanism. But even if you go to what we conventionally associate with demand-side management, you could make the case that that too is a policy that works through a type of a trickle-down mechanism. So your traditional pump priming is essentially government expenditure that tends to favor pro-growth, pro-investment policies, right? That's our primary orientation. And, through our Kaleckian relationships, a stock flow consistent model immediately indicates that government deficit spending is a source of profits. But once again, to the extent that government deficit spending has failed to stabilize labor markets, it favors the capital share of income relative to the labor share of income. But there's another redistributive mechanism at play here, and that's one that works through heterogeneous labor markets. And so if we step back, let's just think for a moment how the private sector labor market works. What generally tends to happen is you have this sort of labor market segmentation where high-wage, high-skill workers tend to experience virtuous cycles of employment, where low-wage, low-skill workers experience vicious cycles of unemployment. They are the ones that experience the fastest decline in unemployment, the longest duration, the deepest declines, the earliest declines. So you have this last hired, first fired, perverse vicious cycle mechanism. And then you've got, for high-wage, high-skilled workers, it's exactly the opposite. There are shorter spells of unemployment, there is shorter declines in unemployment, and faster recoveries. So to the extent that policy tends to work through providing incentives to the private sector to generate investment and growth, it actually feeds these respective virtuous or vicious cycles. And the basic point that I'd like to make here is that we have discovered counter-cyclical policy, government policy, when it comes to stabilizing incomes. But what we need to do is do the exact same thing for employment. The government sector is the only sector that can function in a counter-cyclical fashion. And instead of mimicking the behavior of the private sector, it has to offset it. And that's how I conceive of a genuine counter-cyclical stabilizer. So my research essentially aims to rethink those counter-cyclical stabilizers, and there's more wage data here, and a little bit of discussion in some of my work on how the macroeconomic stabilization methods in the last couple of years really reflect our theories and favor these two different types of demand-side mechanisms. And I argue that this sort of fiscal component of monetary policy has dwarfed the conventional aggregate demand management because of this orientation, right, that we find in mainstream economic thinking. But it's not just that the size of the Recovery Act was too small; it wasn't properly targeted. If you look at how jobs were created through these various contracts, you will find that there were a lot of high-wage, high-skilled jobs created through research and development, energy, and other types of contracts. The direct employment component was minute, very, very small. So the current stabilizer, sort of to sum up this discussion, is we use the unemployment pool. We allow unemployment to develop very rapidly. It kind of creates this perverse effect in a sense that unemployment sort of accelerates very rapidly in downturns, and then we are trying to crank up economic activity to bring it down from these highs. But the stabilizer here is income from forced idleness, right? So you have this sort of thing going on. And what I'm suggesting is that instead of using unemployment buffer stock, we actually use a direct employment buffer stock. And I think that the amplitudes, the changes that you will see in the private employment will be much smaller. And thus the size of the intervention of government spending will also be much smaller. That would be necessary because it would be far more effective in stabilizing the business cycle. So the proposed public employment stabilizer is to use an employment pool at a base wage. I've argued for a living wage. That provides, uses wage income from work as the main stabilizer. The government has never acted in this counter-cyclical fashion. However, it is the case that in the post-war era, public employment as a share of non-farm employment was on a increase. So unwittingly, it did provide some sort of stability in that sort of golden era of American U.S. economic activity, where at the period from mid-70s to the present, that we have seen the fastest erosion in income inequality is also correlated with a decline, a shrinking in the share of public employment as total of non-farm. I am not proposing that we need to have necessarily the secular uptrend in public sector employment. I'm actually proposing that we find a counter-cyclical mechanism for employment that stabilizes the very bottom. So we want to have fiscal policy, right? The genuine sort of bottom-up fiscal policy approach would look like one that provides floor to labor demand, not just output demand, that stabilizes wages and incomes at the bottom, and improves incomes at the bottom faster than those at the top. And there are a number of proposals that you're familiar with. I'm happy to discuss. For the INET project, I am proposing a full employment through the social entrepreneurial sector, full employment program through social entrepreneurship. Okay, thank you.
Okay, thank you very much. Okay, a very good example, having set for the rest of our panelists. That was perfect. Mario, over to you.
Try to get this. Yeah. Okay. We have been talking about dichotomies here, and I'm going to be getting to some basic one in terms of supply side versus demand side kind of dichotomy issue. And in the context of how we could address macroeconomic policy to achieve, what, as Pavlina said, in terms of full employment. And full employment, not in the sense that it has come to be sometimes referred to, but actual veritable full employment, as we used to think of it going back to the 1960s. When I was beginning to study economics, I remember the Economic Council of Canada actually came out with like a 3%, as the full employment, unemployment rate. And that's something which I still very much firmly believe in. Now, if one looks at I'm going to be looking at Canadian data, but I think a lot of this is actually very much a case for the US and also perhaps for a number of other countries. But What we have here is that if we go back to the golden age, so to speak, as it's sometimes referred to, of the 1946, let's say the early post-war period until 1973, what we find, of course, is that we had an economy that was generating jobs. For instance, in 1966, where it peaked in the case of Canada, we reached 3.6% unemployment. And indeed, there was all this belief that we would reach full employment at 3 or somewhere around there percent during that era. Now, if you look at the actual unemployment rate, we could see that there's been a big shift here. If you take the average for the period going back to the early post-war years, until 73, it was around 4.3%. And it jumped up to over 8%. It's almost doubled. Okay, for the post-73 period. And now the question then arises, what was behind that? And as you know, much of the literature, the mainstream literature on that has been to just simply argue that there's been primarily a kind of supply-side factors here at work. And this is why we've introduced different concepts based on choice theoretic kind of framework of analysis here, in terms of natural rates of unemployment or even Nehru or whatever. And these have been the norm over the last, decades, I would argue. And we still subscribe to them nowadays, at least in the textbook sense. You still pick that up, Now, what I would like to do is actually take a different approach here. Go back to something very simple, which is the sort of Herodian type analysis of growth rates here, and try to understand whether or not, in fact, on the one hand, it was supply or demand side factors here at work in explaining why we've been seeing this growing unemployment rate. And I took the natural rate of unemployment here, a la Harrod. I have here, if you look at the equation, you'll see that you have G star there is simply the growth in the labor force plus productivity growth. Okay? Which is what you find, even in the traditional, any of this, Solo going back to 56 argued that, that's where the actual growth rate will tend, etc. And if we look at the actual growth rate of the economy, okay, obviously it can deviate somewhat from that, and we could have, of course, a golden age kind of scenario as we had in the early post-war years, where in fact unemployment was close to full employment, was very low, and indeed where the actual growth rate of the economy tended to be, as I said, close to that natural rate. Unlike what we saw in the post-73 period, where we could argue more around to use a Joan Robinson's expression here, of a kind of leaden age there, where in fact unemployment has been, yes, fluctuating, but fluctuating primarily, as we could see now, except for the 1990s and early 2000s, of course, back up towards some high levels of unemployment in most of the Western world. And the question then is, what is it that has been causing this? Obviously, if you look at this in terms of the usual arguments here, the labor force growth clearly was growing less quickly during that second period. Plus, of course, productivity growth, which is essentially, you could think of it as the rate at which the industry is shedding labor, okay, over time. Well, both of these declined significantly. So take labor force growth, shifted down, as we could see there, on average for the period. If we look at productivity growth, once again, big shift down during that period. And what that really is saying to us, essentially, is that if we were to compare what was going on in the early post-war years, it took around over 6% of growth in output to be able to maintain the unemployment rate constant at some level. While if you look at it today, or the post-73 period, so to speak, if you look at the latter period, it only took, on average, around 3% growth in demand, output growth here, to be able to maintain that unemployment rate constant. And to get it down, of course, you needed somewhat higher, but the point being here that it means less, less spending here, and we could still achieve full employment. And yet, what we actually did here is the complete opposite. So obviously, then the question arises as to, what was the culprit here? And indeed, I mean, the concern has to do with the fact that more and more it was seen as a problem, you know, that we should somehow, especially as it took place, as we know, I mean, usually the argument somehow we had this high inflation and we needed to get down and we needed all kinds of policies, whether it be fiscal or monetary, to get it down during the 80s and 90s and so on. But the point being here that if you look at after the 1990s, we had declining unemployment, but a lot of that was certainly not, it was due to private sector growth, but in the case of Canada, a lot of that had to do essentially with two elements here, which were export sector growth, which is not the case nowadays, and of course, consumption spending or household spending, which obviously, again, nowadays, because of the issue of leverage and all that, will not be the element that is going to spur on the growth anymore, or at least not to the same extent. Now, what we have to say, though, is if you look at the actual periods now, the macro mix here of policy that we had, let's say, for the post-73 period, was one essentially of tight monetary policy initially, you know, relatively high real interest rates, and indeed caused some very serious, you know, periods of slow growth, especially big recessions as we had in the early 80s and early 90s in the case of Canada. And then afterwards, since the mid-1990s, we've been following a rather different policy, which is in terms of rather loose monetary policy, but at the same time, very tight fiscal ship here until the crisis, basically until the financial crisis. And indeed, we could see here in terms of how Canada vis-a-vis even the other G7 countries behaved in this light, which is that if you look at the blue line, which is Canada, we had huge deficits during the 80s and early 90s, and then of course we had a string of surpluses. While in the rest of the world, they're all trying to move in the same direction, but weren't quite doing it to the same extent. Otherwise, all tending towards the same sort of pattern of behavior. And now, what happened, of course, was that we had cuts in spending in a number of areas. In the case of Canada, both program spending and also in the case of public investments, we had significant cuts that actually are even longer-term nature, go even further back than the 90s, but certainly even during that period of the early, actually after the early 90s, where we did have initial growth, but then in 1995, of course, we had a committed policy on the part of the federal government to actually cut back significantly a lot of these program spendings. So one is that we did cut back significantly. At the same time, we also, as I say there, we did do a lot of tinkering with automatic stabilizers in the economy, where institutionally we tried to revamp especially the employment insurance programs in this country. And here's just an example of what happened with transfers from the federal government to other levels of government, what happened in the mid-90s, how it changed dramatically, if you could see here, okay, until the financial crisis. And of course, this is share of public investment as a percentage of GDP. Again, there was significant cutbacks, and then once again, in the case of employment insurance, they were trying to run surpluses throughout this period. Okay, except again, if you look at the period after 2008, we had a slight deficit. Otherwise, we've been trying to milk that cow significantly in order to generate surpluses here, but this had some rather negative effects, as I'm going to argue here, on these broad stabilizers. And what we did here is try to estimate using one indicator that they use at the European Commission, actually, that we adopted as a way of measuring these automatic stabilizers. And it's interesting, this indicator, we only looked at those areas where they're most sensitive, like in the case of social spending versus taxation, personal taxation. These are the two elements of the overall budgetary balance. And what you could see here, if you kind of look briefly at I don't know if I could use the arrow here, okay. You could see, this is going back to the 1960s. Every time you had a recession, like for instance, the 1980-81, early 1990s, you could see that there were significant responsiveness here of the public sector accounts here in favor of major deficits. But if you look at the situation when we had a very deep recession, one of the worst, certainly as deep as the 1981-82 recession, and if you look at, okay, now what I did.
2 minutes remaining.
Yeah, I don't know. Oops, sorry. Sorry.
We're trying to get the incentives right here.
Yeah, okay, got the incentives well, right?
I just want to go left and right.
Okay. And, well, let me just very quickly here. I mean, what we did is that if you look at the way in which these stabilizers are working in this country right now, you could just see that they're really minor in comparison to what we used to have there. And it's pretty obvious from the way we estimated this here. Now, what the way in which the policies were framed prior to the financial crisis, of course, were that it was monetary policy that would rule supreme, and fiscal policy, of course, will be something that should not be touched upon. And this, of course, it was recognized already then in terms of the way in which policy was framed, that fiscal policy can be used when you're hitting the lower bound, as happened in 2008 to 2009, but we should use it as a temporary measure. And I've argued here, as we're going to see here, if you look at the way in which policy should be framed, I would rather subscribe a much more radical perspective on this, going back to Keynes. And I'll just say a couple of words because I don't have much time here. One is that in Keynes, there are basically two policy proposals that he had put forth in the general theory. One was the euthanasia, under the rubric called the euthanasia of the rentier, and the other one was socialization of investment. Now, none of these, of course, if you think of it, what they mean here, the first one basically meant that you don't want to have the kind of policies we have now, which is essentially a kind of neo-Vexelian policy of basically maintaining real interest rates, protect them at a relatively high level. Whenever inflation goes up, you got to raise interest rates, or the other way around. You're trying to stabilize real interest rates or rentier income in a sense. Well, what he argued for was rather the other way around, which is that you should probably peg it at very low levels, these interest rates, and leave them there. And that may well lead to the euthanasia of the rentier, so to speak, but at least his argument was that it would support, in this case, other measures that will be put in place on the fiscal side of things to be able to reduce interest costs and so on. The second one, of course, was the socialization of investment, and as in fact I've argued elsewhere, which is that it should be basically some form of public investment policy in the long term, and it should not be a temporary measure, as we in fact did right immediately after the financial crisis, which is that we reduced interest rates at a very low level, we pegged them for a very short while, but then of course, now we've seen a little upward blip in that, but no commitment in the long term. Second one, of course, is public investment, once again, which is the preferred, this was what was favored as policy immediately after the financial crisis. We had public investment initiatives through these fiscal measures that were put in place. But as I said, it's seen as a purely temporary measure. Once the economy starts to grow sufficiently, we should eliminate that. And indeed, my argument would be rather the other way around. You should have these sustained over the long term. And finally, one last thing, which is that that doesn't mean that you won't have sufficient fluctuations in the economy. You may still have that, even though you may have permanent sort of growth being put forth through public investment, but you also need some other measures to stabilize the economy, which is, of course, the LR proposal that indeed Pavlina talked about, that I would subscribe to as well. Thank you very much.
Okay. Thank you, Mario. And now we'll turn to Barry, please.
It's going to take me just a second to make sure that I have some slides for you to look at and I don't explode anything here. I think I probably just want to switch the cards. While I'm doing that, let me just mention that, oh, that goes somewhere else? Okay, thank you. I do work for the Federal Reserve Bank of St. Louis. Anything I tell you now is my opinion. and not anyone else's. Randy actually told me I should tell you that they may not even be my own opinions either. But I'm not so risk averse. That's more insurance than I need. I'm going to leave this tantalizing graph up to grab your attention, but I'm going to start talking a little bit elsewhere. Or it could just flash. So back probably in around 2004, I wasn't the first person to notice this. People had been talking about it even at the end of the 80s and throughout the 90s, but there was this interesting phenomenon that whenever there was a recession in the United States, consumption bounced back. The American consumer seemed to have this incredible, limitless ability to go shopping to help the economy recover. And I don't have the chart here, but I'm going to narrate the chart for you. So the consumption to income ratio rose from 86% at the beginning of the 80s to around 95% in 2005. So, that's a 9 percentage point shift in income. Aggregate income was growing over this time. That's a big deal. And if you look at consumption to GDP, it also grows over this time period. So unfortunately, I don't have the chart for you, but you can imagine it. The trend is quite straightforward. During this, say, 25-year period from the beginning of the 80s roughly to the beginning of the financial crisis, let's just round it to 25 years and call that the consumer age, because that's this time period characterized by a kind of seemingly limitless growth of consumption by Americans, although I think we found out that it was indeed not without limit. So that's going to kind of actually segue me to this graph. This is maybe what was driving, or what made possible, rather, the consumption to income ratio to grow. Because remember, that's the consumption to income ratio. It's not just the level of consumption rising, it's also growing faster than income. So the saving rate was falling over the time period of the consumer age, and sure enough, from the mid-'80s through right up to the point of the financial crisis, there was about a doubling of the aggregate debt-to-income ratio, and that seemed like a big deal to me, say around 2004, 2005, and I wasn't aware of any model that would help me understand that. There are some explanations, maybe income expectations. People thought that their incomes were going to rise, and their expectations were thwarted year after year, but still they persisted in this belief that just around the corner is the boost to their income, so therefore it makes sense to smooth their consumption across those future golden years. The other possibility is wealth effects. Obviously, there were some financial bubbles, and some people had a lot of capital gains during this time period. And of course, credit availability was increasing, so there were a lot of explanations already floating around. I didn't find any of them wholly satisfying. So I, along with my co-author, Stephen Fazzari, who probably many of you know or met this weekend, we came up with a paper, and even though we basically only had this graph and the consumption graph I described to you, we told a story that was consistent with this, that as mean incomes were rising and the skewness of the income distribution was increasing, a variety of maybe positional effects, some people have taken to calling them Veblen effects, might have driven people to take recourse to debt as a way to grow their consumption, not at the pace of their own income, but at the pace of the consumption of other people that were rising around them. So after writing that paper, we really had our work cut out for us, because we had to first refine our model so that we could generate testable predictions about a consumer that doesn't kind of fit a life cycle, permanent income hypothesis type of framework quite so easily. I'm going to set that aside for today, but just to let anyone else who's working on that know that I'm very interested in that area and continue to work on it. But the other side was to look at disaggregated data to understand the distributional side of this, because I think an important thing for us all to remember is how aggregate data are available and have kind of, they give us a kind of reassuring sense that they're official, and so we can feel good about using them in our research. Obviously, when we go to microdata, it's coming from surveys, and all kinds of issues come up where we feel doubtful about our interpretations of the quality of the data, but I think it's really important not to let distributional effects be obscured by looking only at aggregate data, and of course, I'm sure most people here agree, so I shouldn't talk so much about that. So what did I do? I got a data set that was pulled together in a style pioneered by Macchi and Palumbo, described in a 2001 paper. Basically, the flow of funds aggregate numbers that are balance sheet information that come out at in the aggregate at a quarterly frequency from the Federal Reserve Board are combined with survey data that comes out at a 3-year frequency. It's repeated cross sections, and of course I'm referring to the Survey of Consumer Finance. So what we generate is not a panel, it's not a micro panel, it's kind of a middle aggregation virtual panel or something like that. But basically we are going to aggregate up to 2 groups. So we're going to have people who are at or above the 96th percentile and people who are below that in terms of pre-tax income, year by year. So we have these 2 groups. I sometimes get lazy and just refer to them as the rich and non-rich. We could argue about whether that's fair to describe them that way. So I'm going to proceed to show you some results from that, but first let me just show you, everyone here is familiar with the income inequality that rose during this period. I've heard from several people, Mario, Peter, and others throughout this weekend, good ideas for why this might have happened. I'm not going to try to explain it, I'm just taking it as a fact. But this is the income share of the top 5% from Piketty and Saez. And we're actually going to use income share data from the Congressional Budget Office, but the trends are pretty much identical. And the reason, in part, that we use the other data is because we want to look at disposable income. So I'm not going to talk about that. I'm going to talk about this. This is the demand rate. So it's going to be helpful to develop your intuition for this a little bit. It's not identical to consumption, but or consumption as measured by the national income and product accounts. You could think of this as an adjusted measure of consumption. Basically what we've done is made some adjustments to rationalize the way that transfer payments are treated in the accounts. So if you're familiar with the accounts, you know that there's an inconsistency between the way that certain durables purchases are treated versus others. So if that makes sense to you, great. If it doesn't, just trust me, or if you don't trust me, then just sit quietly and smile. And what I want you to notice here is just these simple linear trend lines. Remember, this is not exactly the reciprocal of the saving rate, but it's essentially that. And you can see that the trend for the top 5% is relatively flat, and that carries over to their saving rate as well. Now, the saving rate is quite volatile for the top 5%. I think that's largely a combination of their income volatility. Remember, income's in the denominator, so as that changes, it makes a lot of noise in the data, as well as the fact that I think they use their saving to keep their consumption smooth, although maybe you disagree looking at this graph. But the real news here is that the bottom 95%, what you're seeing is that that rise in the consumption to income ratio that I described to you is actually mostly driven by the behavior of the people who not only at the household level have less money, but also a lower share of national income. So there's something a little bit perplexing about this because, we would have expected, well, obviously we would have expected something different than this, but this is what we got. So the next thing we want to look at is the debt to income. And here we can see that the debt to income for the bottom 95%, the same story carries over. This is at 3-year frequency. But what you can see is that during this time period, that rising rate of demand, kind of emanating from the non-rich households, was supported by the accumulation of debt. And here you can actually see the saving rate, and you can see that again, there's a lot of volatility in the gray line, but most of the action is driven by the black line. So again, you see this, I hope you think it's convergent evidence. The saving rate is falling and debt is going up. That all makes sense. Now, the last thing I want to show you, and this requires a deeper discussion, so download the paper. We'll talk about this later. But let me just leave you with this idea that as this process was running, in every year it became a bigger problem for the process to stop running. That's basically what's reflected in this graph. The way we got to it is a little bit complicated, unfortunately, but I can explain it offline. But basically the story here is that the longer this, we would argue, unsustainable process ran, the harder it was going to be for it to come to an end. Thank you.
Thank you. Okay. Unlike the other panelists, I do not have a PowerPoint. And what I'd like to talk about really, you'll see focuses very much on what's going on in Europe, and to that extent, I think you'll see a bit of similarity to some of the discussion we had over lunch. But by way of introduction, the title of this session, as you know, is Economic Policy After the Great Recession. And yes, we could argue that the global recession is over, but of course, we're still seeing recession in a number of jurisdictions. And as well, I think it's always important to remember that one needs to think about this from the point of view of what I call levels. And certainly when you look around the world, unemployment rates remain unacceptably high. There are a number of countries, as Bruce pointed out over lunch, where levels of activity remain well below what was achieved in 2007, 2008. There are some countries that have regained those levels, the United States, Canada, but nonetheless, when you look at the amount of unutilized resources from that level perspective, it remains very, very high. Now, what I'd like to talk about are really two things and try to connect them. I'd like to talk a little bit about my view of the legacies of the global financial crises and to tie that in to some views that I have with regard to what's going on in Europe at the moment. Now, there are three features of the global financial crises that stand out for me. The first is the excessive credit growth and the unsustainable debt levels that, for me, really are at the heart of the global financial crises and the Eurozone crises. Secondly, the global financial crisis and certainly the ensuing Great Recession have has demonstrated what I call the fundamental interconnectedness of the global economy. I mean, we knew we were connected. We certainly knew we were connected through trade channels, for example, but I think it demonstrated just how interconnected we are, certainly through, in addition to the traditional trade channels, financial channels. And third would be, and intimately intertwined with these interdependencies and the propagation of the crises, was what I would call the abject failure of the global financial system to fulfill really its most basic fiduciary responsibilities. And what I'm thinking about here are excessive leverage, which we saw in the US subprime mortgage market and in mortgage markets in Europe. Secondly, financial innovation and the types of synthetic products that were being introduced. And as you well know, the idea was the repackaging of risk was to diversify it. But I think in the end, what these products did was really to obscure the risk that investors really didn't know what they were taking on. I think as well there was a failure in the assessment and management of risk at virtually every level. I would include in that loan originators, credit rating agencies, and financial institutions themselves. And then finally, lax financial sector regulation at both the micro as well as the macro level. Now, these features of the global financial crises point to a legacy, in my view, of a debt overhang and indeed impaired balance sheets, which will take time to correct. But in practical terms, this points to three areas in need of critical focus, in my view, of policymakers and politicians. And the three areas are using all available tools to resolve unsustainable debt levels. Secondly, strengthening the global financial system. And third, promoting what I think is important, which is international policy cooperation, and indeed incorporating these interdependencies and spillover effects into domestic policy thinking. So with that, let me shift to what's going on in the Eurozone. And the first point is, in my view, the need to think about this in two different ways. And these two different issues do require, in my view, a particular way of thinking. And the two areas are, first of all, what I call resolving the crises. This is the urgent, if you like. And the question here is, what is the right policy mix that will promote growth, adjustment, and indeed have broad public support? And the second is the longer-term vision, if you like. And here the question is, can the right governance structures be put in place so that the euro and the Eurozone can indeed function effectively in the future? So let me talk about each of these very, very briefly. Now, in terms of resolving the crises and the legacy of debt overhang, we're all well aware of the basic formula of what determines whether a level of debt is sustainable or not, being a function of growth, real interest rates, inflation, and the primary deficit or surplus to GDP. Now, as I look at what's going on in the Eurozone, I see three areas where the focus is. And remember, this is a focus with regard to resolving the crises, the short term, if you like. And there's a focus on austerity, liquidity, and structural reform. Now, I think we're clearly seeing that austerity alone is not the answer. We're seeing depressed economic conditions throughout most of Europe, and indeed, the latest projections that we're seeing in terms of, for example, debt to GDP ratios are actually going up because of the implosion of some of these countries. Now, on the liquidity side, a number of very important steps have been taken to provide liquidity to markets and financial institutions through the ECB. And I think essentially these have been right and appropriate. But there is a problem here, in my view, and that is this distinction between liquidity versus insolvency. And that distinction has not been made sufficiently clear, where some of this liquidity indeed has been provided where there truly is an insolvent situation. And as they say, just kicking the can down the road. And on the structural side, yes, I think we'd all agree that structural reform is important to improve the functioning and efficiency of the Eurozone, but this too takes time and in the short run can depress demand and supply as resources are reallocated. So the question is this the right policy mix or not? And I'll give you my list of what I think is needed in Europe. I believe that additional debt restructuring is needed, certainly in Greece and quite possibly elsewhere, conditional on whether there is in fact a return to sustainable growth. I believe, yes, there is a need for continued liquidity provision, but this should be in the context of providing liquidity in those markets that truly do represent a sustainable situation. I believe there is a need for more expansionary monetary policy in the Eurozone. Fourth, a slower pace of fiscal consolidation, and again, going back to my comment about some of the latest projections and how the current pace is actually leading to an implosion and more of a vicious circle taking place rather than a virtuous. And linked to that, more infrastructure spending that should be targeted, timely, and temporary. And then finally, the recapitalization of banks. And my view is that the Europeans did not take sufficient steps in 2008 and 2009 to recapitalize their banks at that point, and that this really is an urgent matter. So you can see that, in my view, more can and should be done in Europe to promote a more vigorous recovery and to help put the Eurozone on a sustainable track. Well, what about the other part, the governance side? And a number of areas are being discussed, and some of these initiatives are already being taken. And the list, and this is not exhaustive, but discussion around banking unions, fiscal union, ex-ante risk sharing, a sovereign bailout fund, and market reforms of various types. Now, I don't want to go into all of these. I think some of them are critically important. I think a banking union is important to promote financial soundness through a single supervisory mechanism. But fiscal union, I would argue, is not necessary. We certainly don't have that in Canada. We don't have it in the United States. But I would also see a need for some federal level of responsibility, if for no other reason, to have automatic stabilizers to help manage the macroeconomy. Ex-ante risk sharing, things like deposit insurance to offer a consistent level of protection, I think goes hand in hand with the notion of a banking union. Sovereign bailout fund, we've got the launch of the ESM to provide financial support for those countries that are deemed solvent. But I think to complement that, there really is a need for a mechanism for restructuring in those cases where there is an insolvent sovereign. And yes, market reforms, important, greater wage and price flexibility, and so on. So let me just try to conclude and wrap up in terms of what, in my mind, this implies. And as I see the Eurozone today, I believe it faces a serious, what I call policy problem of dynamic inconsistency. And what I mean by that is without the right policies in place to resolve the crises, to deal with that effectively right away, the initiatives to put in place durable governance structures and institutions will never be completed. That the governance reforms will run out of steam because of the failure to generate appropriate and sufficient sustainable growth. And to move forward convincingly on both of these fronts will require a shift of sovereignty from nation states towards the center. And I think this really is where the challenge is, both in terms of political leadership and the willingness of citizens to endure a protracted period of subpar economic growth. So the bottom line in many respects for me is an overriding risk, which is where you have a system under which the political and the economic currency boundaries do not match, will in the end prove to be unstable. Thank you. Okay, we've got almost a half hour, so what I would propose is to turn to my fellow panelists to see if they have any additional quick thoughts or questions or responses to what each of us have said, and then we'll open up to this session overall. So why don't I go from right to left, and Mario, start with you and see if you've got any thoughts post the four presentations.
Thank you. Well, I didn't get around to, I kind of jogged through what I wanted to say there a bit, but I did want to emphasize the fact that what I see here is a kind of long-term vision about how, in fact, we could support growth and ultimately have, high or full employment as the goal. And this is the kind of long-term vision, as I said, that you find in someone like in Keynes here, but with some rather important qualifications, which is that one is that we should, on the one hand, have, as I said, the monetary policy rule should be one that I think would be pin it down and leave it there at a very low level. Just to repeat, secondly, have a committed public investment policy. Now, he had a fairly, he kind of had a view about that that goes back to the 1940s, literally, where he was suggesting that as much as 2/3 to 3/4 of overall investment should be of a public nature. But by that, he didn't mean to suggest that it literally has to be, paving the roads or anything like that. We should conceive this in terms of actual social investment. It should be in terms of providing services like daycare. I mean, these are all important things out there that are crying, and their need is clear. And this is the way in which I think the state should play a role in the economy, while at the same time, and I did emphasize the fact that what we need is a kind of the reverse of what we have done, which is destroy the automatic stabilizers in the system right now. What we need is more supportive sort of institutional policy framework here that does guarantee that over time these stabilizers trigger right away reactions that will maintain the economy on an even keel around this high growth guided and supported by public investment of the type that, for instance, Pavlina was referring to here in terms of employment guarantees. Okay.
Pavlina, how about you? Any additional thoughts before we open it up?
Just maybe to pursue the linkages between my talk and Mario's talk. Can you hear me? Mm-hmm. Yeah? Okay. I want to clarify a point. When I was saying that I'm not necessarily advocating a rise in the share of public employment as a share of total non-farm employment, that requires some careful thinking. That requires, a statement of what we want the public sector to do. And I think there's a good argument to be made that there are so many important public service areas that are understaffed, underfunded, and on and on and on. So we need to rethink what's conventional government, what it's supposed to do, etc. The kind of proposal that I'm advancing, people who will not be absorbed through these different public functions, and they will be left behind. And that stabilizer to employment will include sort of capturing them. And Keynes also has something to teach us about this. He used to argue, I think, in a discussion with me, that it's a rather clumsy way to stabilize the macroeconomy by fluctuating a large-scale public investments, right, through the business cycle. Instead, you want to sort of socialize some of those functions, but then you have to have a direct employment approach that would be in place even in expansions, because the argument was that precisely when the private sector is at capacity and unable to absorb the extra employee, that you still need there's still a role for government to capture them, and that you can find in his discussion about distressed areas, right, and distressed regions in his writing in the interwar period.
Okay, Barry?
Well, when we started the project, it was really about the relationship between inequality and aggregate demand. So it was interesting for me to hear two talks, that really sort of addressed how did we get here, and also what can we do about it. I didn't really address either of those things, although there's some discussion in our paper. One thing that doesn't come up that often, and I wish it did because I'm not sure if it's a bad idea or if it's just something where people don't like to go, but I wonder if people have opinions on whether or not rich people spending more money could also improve some of these problems. I don't know if that's about enticing them with innovative products or services or what, but a big part of what makes the government special is its ability to generate purchasing power, and people who have high incomes also have purchasing power. So I'm a little bit interested in that. I think part of the aggregate demand problem is driven directly by inequality or indirectly through this fact that rich people save more, and that's what we find in our data. And others have found it too. Karen Dinan found that. So it's kind of weird, but I'm curious later on if anyone has an opinion on whether we should be getting rich people to spend more money or not.
I'd be a bit remiss if I didn't respond to Mario's comments on the monetary policy side as a career central banker. And we got into, I think, some of the issues around the efficacy of monetary policy earlier today and yesterday. And I think as we look at the world and the functioning of monetary policy, particularly with the quantitative easing, credit easing, there is still an awful lot we need to learn from that experience, and I certainly would hope that there will be a number of PhD theses coming forward on all of this. But I would just say that one thing we can't forget is history, and certainly my reading of history of the 70s and 80s and early 90s, and not just in Canada, Mario, but in the United States, in Europe, in Britain, was the very high and variable inflationary period, which in Canada at least, through that period, the average rate of inflation was something in the order of 7.5%, which has huge distributional implications, if nothing else. And it was a period of two and a half decades where we virtually had no economic growth, and so the notion of putting monetary policy on some sort of an automatic path and I'm interpreting what you said in terms of real interest rates, there's certainly some economic history that points in that direction, but there is a demand management role for monetary policy still in my mind. But I think one of the really interesting things coming out of all the presentations is this issue of not just the role of fiscal policy, but the mix of fiscal policy, including through the automatic stabilizer. So let's open it up. We've got a good almost 20 minutes. So if people could go to the mics. I saw one hand. Well, you're closest to that mic. Why don't you go first, and then we'll go to the left.
Okay. Well. Thank you for all these presentations. I'd like to ask 3 questions to Paul Jenkins on his views about the Eurozone. 3 things that I noticed. First, you said that the ECB should have a more expansionary monetary policy. I kind of wonder how much more expansionary it can be when the overnight rate of interest there is less than 1%, and when billions of euros have been given as advances to the commercial banks. My second question is, you mentioned that labor markets should be more flexible. The wages and prices ought to be more flexible, and that this would help the Spanish economy. I have a hard time seeing how that can really help, especially in view that we had a meeting earlier 2 days ago and yesterday where we discussed agent-based models, where it seemed that if you have more flexible wages, then it will just lead to more unemployment. So I was wondering on which base you were saying this. And the third thing is I was a little bit surprised that you didn't give as an advice to the ECB to focus more on keeping the rate of inflation stable. You just mentioned it in a response to Mario, but you know, in Canada it used to be said that the best thing that the Bank of Canada could do was keep the rate of inflation constant at 2%. So why is it that you don't recommend that as a policy to the ECB?
Okay, well, let me quickly respond to those. I'll take them in reverse order. I'm certainly not arguing at all that I'll call it price stability isn't the most important long-term contribution of a central bank. But what I do see in the euro situation, and I'm drawing on my Canadian experiences, is a situation that is far from inflationary. I know headline rates, and I don't have the latest numbers, but headline rates that are 2%, maybe even a bit higher. But following an approach that is used at the Bank of Canada and looking at a core rate of inflation, it's well below 2%. And it's not that you target core, but empirically and statistically, core inflation is a very good predictor of future inflation. So combining that with my very first comment, I do see scope for additional monetary policy easing in Europe, very much tied to that mandate around price stability. And I'll come back to that in a moment in terms of what the ECB has and has not done. On the labor markets, perhaps I'm being naive here, but I tend to think about this, again, perhaps from a Canadian experience. When I think about an economic union, in my experience, Canada, or if you want to think about an economic union called the Eurozone, what are some of the characteristics that make that economic union, monetary union function? And Europe is not an optimum currency area. Certainly Canada is not an optimum currency area. But one of the elements that Canada has seen some success on is an improved flexibility of labor markets. So if you get a shock in one part of the economy, let's call it a terms of trade shock out in the resource area of Western Canada, that it can attract resources, particularly labor, from other parts of Canada. And you get an equilibration process through real wage adjustment. And I think that has worked well, increasingly so. I think that's an important part of how I see the U.S. functioning. So it's very much in that spirit of wanting to have, for an economic union, better flexibility to be able to respond to asymmetric shocks. So that's the point there. Now, on the monetary policy side, I certainly agree, and this point was made earlier, that and Bruce was very forceful on this point at lunch, that there's a lot of uncertainty around the effectiveness of quantitative easing or credit easing, which is somewhat different. But I guess the counterfactual I would make in the case of the United States is if the Fed had not done what they had done, what would the situation look like? So I think what the Fed has done has been absolutely correct. We can debate around some of the specific markets they've gone into. But I think the ECB should have undertaken a much more stimulative monetary policy 2 years ago. And the outright monetary transactions mechanism that they put in place recently is cast in a monetary policy narrative, and indeed it's had some impact in terms of bringing some spreads down, but of course it hasn't been activated because of the conditionality around it. Now, will that last? Will it not? If it really is a monetary policy narrative around it, what are the sorts of impacts that would have through the economy to support the economy? So I think there are questions on that front as well.
Neil Lancaster from the UK. I was just picking up on what Barry said about aggregate demand, and I saw there a real missed opportunity for sustained demand, particularly with the poor, or the non-rich, as you called them. I'm interested in policy here, and I saw kind of ex post two policies that would have helped. As Mario said, better public investment, particularly as that household lending took off, would have done something to bring wages up and therefore maintain spending by the non-rich. But also Pavlina's suggestion that there's a insurance kind of wage floor in real crises. So my question is more general, which is, since the market mispriced risk quite clearly from at least certainly from 2000 onwards, the risk of these household debts, and wasn't investing as much in businesses, does the panel think that the market is pricing risk correctly today?
Okay, Mario, do you want to take a first cut at that?
That's it mispriced risk in 2008, but I think if you're looking at the way the credit rating, I mean, the best example of this is what is even right now with this fiscal cliff and all that in the U.S. But I go back to last August. In August 2011, where there was a big debate over whether or not we would have the fiscal cliff there, and perhaps they face a problem of not being able to pay their own employees, in the case of the U.S. government at the time. And it's very interesting that we got, of course, Moody at the time downgrading the U.S. government. And to me, this is a good example where I think they were just totally out to lunch. And I mean, as much as I know that they do and can evaluate somewhat risk. I had a good friend of mine literally used to work for Moody's. And so I know that these are not incompetent people, on the contrary. But what you do find, of course, is that I think they, we do see a problem here when it comes to the way in which they evaluate the governments in particular. But when it comes to private sector, assets, I think what you do find, of course, is that I think they've been a lot more careful now than when you compare it to the behavior just prior to the subprime crisis. Okay, so I mean, I think that they're being a lot more prudent because I think the whole industry is at stake right now. Whether or not they should even be, maybe they not only should be regulated, but maybe we should have something that should be of a public nature to provide that kind of information. And indeed, I think they're very concerned about that kind of reaction. But as I said, the way they deal with governments right now, I still think there's a big problem there.
Let me answer this a little theoretically. I actually happen to think that the markets misprice pretty much everything. I take my cue from the work of Hyman Minsky, but basically, I tend to see markets as feeding vicious or virtuous cycles. He argues about a system being explosive system, right? Even pro-growth, pro-investment system being an explosive system, or that it sort of feeds on that mechanism and sort of inflates asset prices and inflates more investment, encourages more investment there. And then when the process reverses, it collapses. So there is no self-correcting mechanism here. So so I do agree that just when you bring this down to the ground, to the real world, that people are being more prudent, they're being more careful, they've been burned, but that still doesn't mean that markets actually price correctly investment, assets, employment. And so, for me, it's more useful to actually see how do we provide floors or ceilings on these things, whether it's employment, whether it's investment, whether it's asset prices. How do we stabilize a system by recognizing that prices are not the adjustment mechanism.
Let me start with a couple numbers. Kind of reflected in one of the graphs you saw, by the middle of the 2000s, around 2005, a return to our benchmark savings rate, which was an average from the early 80s, a return to that saving rate by the non-rich would have required a withdrawal of demand equal to about 8% of GDP. And if you looked at the edge of that graph where it came back down to the axis, we basically got that removal of demand, and we also got a recession that we liked so much we called it great. There's a tantalizing link also to inequality in that if you sum up the demand accounted for by the cumulative decline in saving over that period, so basically integrate that cumulative shortfall, if understanding that's a little bit speculative conceptually, but just as a start, that's roughly equal, the shortfall in savings is roughly equal to the shortfall in income that corresponds to the changing income share. So that doesn't prove anything, but I think it motivates me to do more research to try to establish the connection between the sort of stagnant incomes, the rising inequality, and the willingness to take on this debt to, say, maintain a standard of living or keep up with the Joneses or some such. However, I think it's really important for us to recognize that no one forced anybody, at least I don't think anyone forced anybody to spend money that they, sort of couldn't afford to, but people chose to. And for me, that's kind of what's really interesting. Maybe in some sense, the economy needed that aggregate demand, and so a variety of forces kind of emerged to draw that aggregate demand. I don't know, that's kind of a speculative thing for me to say, but what I'm interested in doing is understanding better at the micro level, and I plan to do that by looking at actual household panel data. Can we identify what actually drove spending at the household level that, of course, aggregates up to the startling numbers that I shared? So I don't know if that's really an answer to the question. I think the government can maybe be the most effective solution in some sense to some of the root causes of these problems, but I still think it's very interesting for us to understand why people made the choices that they made in reality and the circumstances they faced at the time.
Yeah, quick thought on the question, and it's a difficult question to answer. You've got you've got credit risk issues, you've got market risk, operational risk, and in the case of the Eurozone, this risk around breakup, and you listen to Mario Draghi, and that was very much the motivation for the outright monetary transactions mechanism that they put in place to deal with that and deal with it in a way that would provide unlimited support if called upon. So is the market pricing risk appropriately today? I think it's hard to say yes, it is. And I think part of the reason I say that is there is just so much uncertainty still in the minds of markets with regard to the direction of policy, and with that and the uncertainties around the direction of policies and the risks associated with the global economic outlook and the vulnerabilities that do they have it right? I would have to say no. Any other questions? Yes, John. Yeah, if you could go to the mic, and that way everyone can hear it, and I think they're recording it as well.
Yeah. Thank you. I'm John Smithin from York University. I would like to ask a parochial question, if I may, mainly of Mario, but Paul, you may also have something. All politics is local. As you were talking, Mario, to a point, I was thinking of the talk that we had at dinner, last evening, where there was discussion of the relationship essentially between American politics and the American economy, right, and the interaction between those two. Mm-hmm. I was also struck by you sort of singling out the mid-60s as sort of a golden age, as I say, parochially in Canada. The unemployment rate was at its lowest. Actually, income was more evenly distributed than it is today. Canada was very high, if not the highest, in the sort of standard of living tables around the world, and so on. So a pretty good picture all the way around. And I always think of Expo '67 as sort of like a kind of high point there. Okay, then it all goes downhill as you've graphically demonstrated, after that. And it's a long time period, as long as Emma Rothschild was speaking about. The thing that occurs to me, politics versus economics, what happened in 1968 in this country? And the answer is Pierre Trudeau. And that was a political regime which lasted, politics is different here than in the United States. This lasted for 16 years, effectively, until 1984. So did that have anything to do with it? Your thoughts. I mean, that was certainly the case made in the US politics yesterday evening.
Could I answer?
Yeah, absolutely. Over to you.
I don't think I have a simple answer, except that I would obviously see the connection here, but it's not so simple. I mean, you had when he came to power in 1968, we had actually Minister of Finance, John Turner, who then dropped out. I mean, as you know, he's the one who kind of moved us away from a fixed exchange rate, for instance, in 1970, and moved us away from Bretton Woods way before other countries did at the time. Also, however, what happened, I think more importantly, in 1973, there was Louis Radziminski, who was replaced at the time by Gerald Bowie, governor of the Bank of Canada. And there were a couple of things that happened there which I think are important. One is that at some point, immediately after that first oil price shock in 1973-74, the federal government did react, and it reacted in two different ways here, actually, which is rather interesting. Because that kind of brings me a little bit to even something that Paul here commented on, which is that on the monetary policy front, they went so-called, in 75, they went monetarist, quote unquote, which was essentially trying to target, M1 at the time through this policy of gradualism, as they called it, in order to get the inflation rate down. But the way they did it, of course, was by adjusting interest rates. Okay? Never, at no time did they actually say that they were trying to control, for instance, the monetary base. But they were targeting M1. Okay? But they had a hard time by 1982, as we saw eventually, because then they moved away from that. At the same time, in October 1975, we adopted the Anti-Inflation Board, which was an incomes policy measure. Now, that doesn't fit well the usual monetarist view about how to deal with inflation. In fact, if anything, that's something that you would have found more along the post-Keynesian camp and so on, in terms of incomes policies. But both, I think, were, in a sense, incomes policies. Okay? One was a kind of rentier type incomes policy, that is to say, by controlling interest rates vis-a-vis the inflation rate, what you're actually doing is a type of incomes policy. And by, at the same time, creating more unemployment, for instance, in the process, or increasing the so-called output gap or whatever, that is also a form of incomes policy because it deflates wages, perhaps, or affects wage growth. So to me, that's an incomes policy as well, but we call that monetary policy. But there was another type of incomes policy that lasted until 1978 under the Anti-Inflation Board. Now, there's a lot of debate as to its impact, again, and I won't get into that there, but just to say that this was part of an active policy where within the government, clearly, there were differences as to the way to go. And this is perhaps the best example of what happened. where you had two kind of visions here as to how to deal with the inflation rate at that time. One trying to somehow, control costs, whatever, wages, and prices. Well, the other one, as I said, was done through some sort of monetarist mechanism here, which, as I said, never really worked, personally, I would argue. I'm not sure if that really addresses your question. Yeah. Okay,
well, time is up. I'm going to offer one quick thought, not on the specifics of what Mario talked about in the Canadian context, but I think he raises another important issue in the spirit of this conference. And yes, Canada was the first country to move to a flexible exchange rate in 1970, which was quickly followed by other countries moving in that direction, and of course including the decision by the United States. And the thought is simply that the Bretton Woods arrangement was a particular type of arrangement, a fixed exchange rate arrangement anchored to the US dollar, it in turn anchored to gold essentially. And through the 1970s, and I would argue even today, and particularly today in the context of the emergence of countries like India, China, and Brazil, this shift to what I call a multipolar world, is the issue of the functioning of the international monetary system. And where are we headed in that regard? And through the 70s and into the 80s, I think there was a period where countries, and I would include Canada and I would include the Bank of Canada in this, that we were really searching for a way to anchor policy in a flexible exchange rate world. And so that's kind of a bigger issue, but I think one that is very, very critical as we go forward. And what are those arrangements? Are there conventions? Are there rules? And with the emergence of whether it's the RMB or other currencies in the context of that, I think these are very, very critical issues. So let me, on behalf of everyone, thank our panelists. It's time to wrap this up, and I guess next on track is to go back over to the atrium in CIGI for a reception and then dinner and Katerina's address. So thank you all very much.